Good weekend, all. Ira Epstein of Lunar & Associates with your weekend edition of your agriculture update for this Friday, the 17th of May, 2019, about 3:30 p.m. Central Daylight Time. So what we've got in the grain markets, and that's what we're talking about, that in the meat markets primarily, and we'll get to the soft commodities, is a weather market. Bad rain, driving corn prices up. The problem for those that want to get overly bullish this market, as you approach the $4 mark in corn, you're probably going to see the farmers come out in droves to sell whatever corn they have. This is their gift on pricing. Why would you risk making X amount an acre for things to get even worse? So you're entering that time frame, that period frame, that price frame, all three of those. In the wheat market, you got to think of wheat like a pork belly. It just goes zooming up and down dramatically. And in the soybean market, beans took a hit today for another reason, on top of not only did they climb a little this week, but it didn't help the matter when China basically retaliated against the Huawei statement that the president made yesterday when he said, you know, we're not buying any of those products. We're not going to let our company sell to them. He's basically going back, just like he did in December, to what he's putting on the pressure on ZTE Corporation, if you remember that. Huawei is really owned by the Chinese government. Any way you want to look at it, they can say all they want, that's what it's about. The Chinese make a trade deal, we thought. They had agreed to certain things, we thought. You sit down to the table a week ago, and that all changes. But we're the bad guys because we're retaliating. Okay. Get America out of there, I guess, is the way it's going to work. So as a futures trader, you've got to look at what this all means. And you look at what the markets are doing, what the meat markets are doing, and you take it from there. Certainly seeing a high-priced dollar makes our goods a bit more expensive, in fact, a lot more expensive for export. The stock market, when it reopens, we're just about at that 3:30 time frame. We'll see what it does, but it fell back from gains earlier as this news from China was breaking that there'll be more retaliation, and basically they've uninvited us for further talks at this point. When we look at soybeans for the week, really today's loss, the 18 cents that you're down today, was most of the week's loss. You're down 19.5 cents for the week, so it's primarily at this point. We've come back down into this low area of 821 3/4, and as you can see, all we did this week, and I want to remove this, you had a gap in a chart. Charts, as just a chartist, throw the name off the chart. Chart gaps don't generally hang around very long. You can get what's called a breakaway and a runaway gap as a chartist. Those can hang for a long time. We saw some of those to the upside in stock indices. In this market, you had a gap from 2 weeks ago that you created. All you did this week is you came up, you filled that gap. That's how I'm looking at the longer term. When I look at the swing line on a weekly basis, and that's what we do here, we're not looking at the daily charts, we're trying to get an idea of the bigger picture. You've got lower highs, lower lows, and you filled a gap. When I put on moving averages, the resistance way up here, and I think the farmers would be jumping up and down if you can get up another 60 cents in the soybeans for them to do hedging or whatever they'd want to do, but that's a difficult number to get to. You're lined up in a bear, and you've been in this way a long time since you had what's called a bearish crossover. It's when the shorter term moving average gets under the longer term, and you've stayed that way. Yes, the market stayed on the right-hand side for a while, but the collapse in prices really began in March, and it is carried right on through then. When we look at Bollinger Bands, whether it's on a daily chart, weekly chart, minutes, 15-minute chart, it doesn't matter. The odds are in the algorithm that only 5% of the time will you stay above or below the black dashed lines. Well, what you did this week is you had 3 weeks in a row under, now you closed over it. That's all that happened. So the market's away from that. The breakout was from the sideways action. You've been riding the market to the downside, and you have momentum that's flattened to a degree. It's no longer pushing down the way that it was, but it certainly hasn't turned to the upside. It could, but it hasn't done it at this point. When we come to the meal market, take a look at what you had. You had a market that was trying to break out to the downside. You were under the lower Bollinger Bands. I'll repeat it again. 5% of the time do you stay under it. I created a rule of thumb that I like to use, that each successive close outside of a band takes away one of those percentage points. So as you get closer to that 5% number, the better the chance that you're going to get a pop in the market. Doesn't mean you're trend changing, just a pop to get to the other side of that. So here we are under it last week, not this week. This week we had closed at 299.90. Here you're under the number. Here you're under the number. All you did is rally back. What else do you see? If you look at this week's high, it was 304.90. What is the 18-week average of closes? 304.70. If you go back and you do your own chart analysis, be it an 18, a 20, 21-day moving average, a lot of people use different numbers. They think that they make a big difference. I don't. I think these are all right in the realm of it. I picked the 18 because I like it a lot. I've seen it hit more than the other numbers. And what do I mean by hit? When a market is down a long way from it, you're always looking to see where could the resistance be should the market snap back. If this market was up at the upper Bollinger Band, where could the support be if it fell back? Down to the band, where could it go back to? You see what I'm getting at? You're looking for those things. Well, in this case, it's still the 18-week moving average of closes. You went to it and you failed. Momentum here, not like the beans. Choppy as can be right now, and that sort of goes with what the price is doing. On the soy oil, the momentum, unlike meal, hasn't turned itself or begun the choppiness, but you did get back over the what? The lower Bollinger Band. Resistance back up at 28.96. What's the trend? Clearly to the downside with lower highs, lower lows. Admittedly, the first challenge of hitting the Bollinger Band was the first target. The market hit it. The first challenge was back here. You came back into that zone. I can go on the beans and so on. That's what I think happened. Now this is a different type of chart. This is a weather market chart right through here. And you put on a rather dramatic gain this week for the weekly chart in corn of 40 cents. That's big. I would expect that you're going to have a lot of resistance if you get further bad weather, which I don't know, back up at the top Bollinger Band. But like I'm saying, there'll be a point, even with that weather, where crops materially, it doesn't rain every day forever. Now, if it did, off the chart. I'm not betting on that. So I'm looking at the market of having what we call a dramatic reversal, and until you take out this low of this week again, 335.5, I think for the crop season, the odds favor that a low of sorts is in place, but I also expect to see hedging by the farmers coming above the market. Could you trade something like that? Pretty hard. How would you have been able to catch it other than just picking a bottom in the market? The wheat market's more realistic. What you've got is a chart of lower highs, lower lows, resistance levels, very clear. Let's take this week off. You've got two of them, the 18-week and the 100. You can see a crossover. That's when the shorter term average gets what? Underneath the longer term. The market had no follow through from that, which was really interesting. Here's where it began. You didn't make a lower low. See? Didn't make it, and that's what you typically look for from there, but you've rallied into a resistance point, and once again, that 18-week average stopped the market. Now, there is divergence here. Divergence coming in the sense that momentum's trying to turn up. You have a market into a resistance point. The trend is not up. If you decide the trend is made up in a pattern of in a downtrend, lower highs, lower lows, that's what you have. Take out now 478, and you still have the lower low, higher high. So I'm still looking for the pros to defend their short positions right in this general area. In the cocoa market, we rallied to the upper Bollinger Band. Remember, 95% of the time you stay within that. You've got a big sideways pattern. One time you tried to break out and you went right back and noticed the numbers that you've been fighting at. The same thing is going on right now. When you look at the longer term chart, the weekly chart, all you're doing is hitting back and forth at this 18-week average of closes. Now, should the market take out 2291, the pattern would revert from higher lows to lower highs, lower low. But the current pattern is a difficult one. You've got lower highs and higher lows. You're narrowing in like that, trying to figure out what next. Going home, I say the bias is up. The trend is up because you've got the higher lows at least, and that's the legacy of the market, and momentum flattened out. Take out 22.91, I will change my opinion on that. In the sugar market, you keep hitting this lower Bollinger Band, which is a target. If the market's going to use this sideways action to use it as, let's say, power, a thrust in it, like you're stuck in a pipe and you're spinning, and it starts down from here, watch out. It could gain momentum on you. Typically what happens on daily charts, you get overbought, oversold. I don't think that's the case on weekly. They point in a direction and that's where you're at. This is called riding the lower Bollinger Band. You can negate the downtrend by taking out 12.15. Don't do that. The bears have control. They've got lower highs, lower lows, momentum down, bias down. When we come to, I should have labeled this for you. This was coffee. The coffee market is still in big trouble, unable to bounce at all. Sorry, I don't have the labels on it. Lower highs. Now, if we look at this low last week, this low was 86.65, and the low here was 86.35. So we got a bit of a pause as the market came up. It was a terrible daily close today for this market on the daily charts. If you take out this 86.65, the odds could favor moving back to the band, to the lower Bollinger Band. Trend down, bias down, momentum down. This is the coffee chart. Sorry, it's not labeled. In the cotton, you've extended a bit, maybe too much under the Bollinger Band. It's not a bottom pick. 95% of the time, the market stays within it. We'll see if it does that or not. What the trend is, though, is lower highs, lower lows. The first objective was the lower Bollinger Band when you hit it. And often when you hit it, you get a snap back. You exceeded it this time. We'll see if it has any follow-through to it or not. In the cattle market, momentum is down. Lower highs, lower lows. The first real support zone was right here. Actually, it was the first hit of the Bollinger Band, happened to come in this general zone with the 100-week average. It didn't look back. So 1 week under, 2 weeks under. This is the third week. So I give next week a 2% chance, using that 95% of the time the market will stay within the bands, 2% chance of staying outside of the band. That is not that I'm bullish. Please understand that. And because the 100-week average is here, I would expect the first resistance, if it rallies, to be that number. In the hog market, the longer-term trend is still to the upside. The market is still betting, regardless of what China says, that they need more pork. Now, whether they get the pork from the U.S., now that's not necessarily the case, because wherever else you take it, we'll export pork to other parts of the world too. Doesn't have to be China. And the overall picture has been one of bullishness. It's interesting because I read an article today that they might have the beginnings of a way to cure and stop this African swine fever. Has it proven itself? Not yet. They're on to something. It's out of Europe. We'll see what it means. The market this week didn't care. You were up 862 points. That's 8 cents. That was a big move to the upside. I talk about this and a heck of a lot more in my morning subscriber video. Now, what you're seeing here is me doing a generic. I'm bullish, I'm bearish. I really can't say in this video, buy here, sell there, put your stop here, do this and do that. I do it in my morning subscriber video because the law says it has to be behind a user ID and a password to a select group. I can't put out, do that on YouTube. I could, I'd lose my license, so I don't do that. What I do here is very generic. I cover everything, including the metal markets. We're going to fix that this week, okay? It's just us forgetting that. We see it so often we didn't pay attention. But what I do, I record at 6:15 in the morning Central Time. Generally speaking, that recording is rendered and published by 7 a.m. Central Daylight Time. Now let me explain the meaning of the times because they're important. I've already seen Asian market reaction. I've seen European markets, what they're doing. And at 7:30 a.m. on up sometimes to 10 in the morning or so, we're getting the U.S. economic data. So I'm talking to you before that data comes out, trying to offer specific trade ideas. So you have a trade idea on your own. You wake up in the morning, well, I'm looking at the market and I'm pretending I'm you. I like to know what somebody else thinks of that because I want to pull the trigger, or I'm not certain, should I pull that trigger? My goal here is to be the other end of your thought process. If you like what I do in these tapes, I think you're going to like the rest a heck of a lot more, because I'm able to really let go in those tapes and do them. I don't appear in them. It's my voiceover. The charts, these are my actual charts on my computer, and I'm giving you what I think should be done in the market. To start you out, 26.5 cents a day if you want to try it. That's $7.95 for 30 days. It does not go by the month. It goes by 30-day periods. After that, if you decide to stay with it, you can stay on a month-to-month basis, or you can move to a yearly basis. $15 a month, $156 for the year. You choose, and again, you can stop. So why not give it a try? Go to our website. Under the word education or research, you'll see a pull down that says Ira's morning subscriber video. Click it and away you go. I'm Ira Epstein. This is longer than normal, but we're in weather markets and you got to pay attention. Take care.